Good afternoon, ladies and gentlemen. My name is Manda Troutwine, and I will be your chair for this session. The guys have told me that they would like to pause for questions throughout the session, so it might be handy if you can have your app ready to submit questions during the session, and then we will pause every once in a while and go through the questions. The need for valuations and the assumptions that should be taken into consideration can vary significantly depending on the circumstances in which the valuation is prepared. This session takes a forensic look at a progressive case study to investigate instances where valuations were needed and shed light on the decision-making process, especially for international business. You will gain an understanding of the unusual issues to be considered with valuations and the art or judgment that is required for specific types of valuations. Presenting this session is Simon Delgado, who is the Managing Director of Leadenhall Corporate Advisory and one of Australia's leading business valuation specialists. Simon has worked in the financial valuation industry for more than 15 years, where he completes valuations for both private and public companies. He also regularly conducts valuation seminars on valuation theory and practice, and provides advice to business valuers, lawyers, and accountants. Presenting with Simon, all the way from Mumbai in India, is Rajeev Shah. He is a leading authority on valuations, mergers, and acquisitions. As Managing Director and CEO of RBSA Advisors, a global independent valuation and transaction advisory services firm, Rajeev leads the teams involved in investment banking, transaction advisory, financial valuations, business development, and he spearheads major client interactions. Ladies and gentlemen, before we get started, I thought I'd just quickly ask everyone in the audience if you can please raise your hand if you have been involved recently in the preparation of a business valuation. All right. And if you have recently had to review a valuation that someone else has prepared. Okay, great. All right, well, please join me in welcoming Simon and Rajeev. Thank you.
You going to lead?
Okay. So, thank you all for coming. When we look at the world today, some of us feel that the world has gone crazy. The valuations of all the FANG stocks, the technology stocks, and some of the deals that are happening in the new economy space, it is astounding. A recent study that we conducted said that one of the largest transactions which has happened in a new startup, retail, Amazon kind of startup, valued, Walmart acquired Flipkart for $16 billion. At that time, that one transaction was valued more than all the retailers put together in India. Now, you will come across many of such evidences, the Ubers of the world and the Netflixes of the world, where the valuations have gone crazy. And somehow the questions always comes to us, are these valuations right? Is there some science to it? Or is it an art? Or it's a witch hunting? I mean, it could be a complete black box. Often the questions raised by accountants is that this is a black box and I don't understand it well enough. So can you please explain us? And that's how the question always comes, whether valuation is a science or an art or a combination of all. And here we are trying to address some of those questions. So me and my colleague Simon have tried to put together, and Simon has done a lot of more work than me, is that we've put together a few case studies and some introductory concepts in valuation. We hope to run you through all of that. And maybe we'll, as Manda indicated, we'll ask, and we would love to take questions along the way rather than keeping them at the end. And that's how we will take it. So just to, if we start with some of the questions of fundamentals of valuation, which change, which never change. They are same whether you are in US, you are in Australia, or you are in Japan, they would always remain the same. And if you as accountants have either done valuations or commissioned valuations, or you have been users of valuation services, I'm sure you will come across many of these questions, like what is the date of valuation? Things change over a period of time. What is the purpose? whether it's a tax-driven valuation, whether it's a financial reporting, whether you're advising someone on the deal, and what is the standard of value, whether what I say and you understand, are they same? Is our definitions, our interpretation same? And is there a standard which would at least standardize the whole process and tell that, yes, what I say and what you understand is the same? And what is being valued? Is the asset being valued? Is it being appropriately recognized? Are there changes there? Whether you understand most often the concept of an equity value or a business value or an enterprise value are misunderstood. They are slightly different from each other. And while in a simple colloquial language, people interchangeably use it, but equity value is different from an enterprise value and a business value. So what is being valued? Is it your company? Is it your business? It's intangible assets. So, and what is our role? Are we expected to be as an independent expert, or we can advocate on behalf of our client? If we are working on an M&A transaction, are we expected to advocate a position, or we are expected to take an independent and fair judgment? So many of these questions which we hope to address. Yes, please.
I'm going to steal the thunder now. I was very lucky a few years ago to be in Nepal. I saw what appears on the left. I saw this beautiful structure. 1 week later, this is what was left of it. Massive earthquake in Nepal. So this highlights to me how important the valuation date is, because absolutely. Define my date. If my date is 1 week before the earthquake, then I'm looking at a beautiful, culturally important building. 1 week after the earthquake, I'm sorry, there wasn't a lot left. So defining our date is quite critical. I was having a discussion with a valuer last night, and he was saying, well, am I doing my valuation as at date of acquisition, or can I take subsequent events into account? That is a critical question, and it depends a little bit on the circumstances of the case, but often it is, what is the date of the valuation? I can only should only take into account information which came into existence as at that date.
So again, what are the various purposes? I mean, there could be 50 different purposes for which valuation could be required. It could be for tax, it could be for financial reporting, it could be court. You are independent, you are acting as an independent expert. It could be just you're advising someone for making a deal. It could be for mergers or acquisition. It could be for banking, securitization. And interestingly, the value could change with different purposes. Your value could change, your methodology could change, your approach can change. So it is important to pre-agree the date of valuation as well as the purpose of valuation, and all of you accountants would actually understand whether it is for impairment review or if it's for purchase price allocation. So the importance of each valuation would differ. So it's important to understand this.
And on that point, congratulations, guys. We accountants took 2 words, fair value. Just 2 little words. And we wrote 150 pages trying to explain what those 2 words mean. Well done, guys. I think we understand less about the concept of fair value than we did before the 150 pages. But the other confusion is we took a term, fair value, and we said, by the way, fair value, you then have to go and read your international valuation standards. Fair value is actually equal to market value. So the fair value that we use for accounting purposes is different to the concept of fair value that could be used in court. Court is often around a concept, what I call fair and equitable between the parties, which is different to the concept of fair value for accounting. So congratulations, guys.
And when you look at the international valuation standards, which most countries are adopting now, you will have several definitions of various kinds of value. So it is important for we as accountants to agree on what we actually want. And most often, when a valuation report is commissioned, it is important to have that clarity, because otherwise we would be talking different languages and disagreeing on them. As he said, that while you could do a PhD on the definition of a fair value, it is important to understand it in less terms.
And that becomes even more of a problem as we deal across multiple jurisdictions on an international transaction.
Correct. So if a US company makes an acquisition in UK, India, and Australia, then each of those jurisdictions actually understand fair value in a different way. So most often it makes sense to go back to the international valuation standards and actually use that definition, which can be used internationally without much differences in interpretation.
So the next issue is what is being valued. It's always a simple concept. Everyone's just saying, well, we need this valued. The best example I've ever seen of the problems that occur is in 1967, London Bridge was sold. And it was sold and taken to Arizona. Unfortunately, the person who bought the bridge bought London Bridge, named as London Bridge. Well, London Bridge is the bridge on the left-hand side there. What they thought they were buying was the bridge on the right-hand side. You laugh, it's serious. So for us as valuers, being very clear about what we are valuing, and that could be, are you valuing a particular company? Well, actually, am I valuing the business or am I valuing the company? Are we valuing the hard assets? Are we valuing the intangible assets? It's interesting to me, most of the people small business, mid-sized businesses that come to me actually ask me to value goodwill. That's why they come to me and they say, oh, well, we've worked out the value of our tangible assets. We just need you to value the goodwill. Well, actually, we don't value goodwill. We value a business. We then strip out the value of the tangible assets and we get intangibles and goodwill. But being careful about what you want us to value is critical.
Most often the client will have a vague understanding of what he wants. I want to value my business. Then when you get into conversation, no, I want to value my equity. And thereafter he would, no, I want to value my goodwill. But eventually it would fall on the valuer as well as sometimes the accountants to make them understand what exactly is required. So that this is our role, and as valuers or accountants, we must be conscious of that.
And if you think we as accountants get it wrong, wait until you talk to the lawyers. They really don't understand. So this is one of the ways we try and break up the value of a business and the way we the value of a company and the way we talk to people about what is in a company. The first thing is there is an operating business, an enterprise value. You'll hear corporate finance people talk about EV, enterprise value. So that's the bit that we value. The operating cash flows, normally some measure of profit or cash flow, even better, will give us a value of enterprise. Plus, we will add on surplus assets, which is any asset not required for the operations of the business. I've had planes, trains, automobiles, I've had holiday homes, I've had all sorts of things in that definition of surplus assets. And then from that, we deduct debt. There are exceptions, banks, financial institutions, those sorts of things. When we value the operating business, we include debt. But certainly for 90% of the valuation work done in Australia, we would value the business on a pre-interest, pre-debt basis.
I believe that's a global standard as well. But what is important is to understand this construct, because sometimes we end up confusing the equity value to the enterprise value, and people would use it interchangeably. We as accountants or valuers or financial consultants should know better out of it, and we might have to educate or at least convince our clients that this is the case. More importantly, there is also a concept when we are talking about listed companies. let's take an example. Say Mark Zuckerberg wants to sell Facebook stock. They're listed, so there is already a price. Thousands and millions of shares are traded. Microsoft, millions of shares are traded. But does that amount to the value of Bill Gates' stake or Mark Zuckerberg's stake? No, because they effectively exercise control over the company. So the shares which are traded are essentially liquid minority stakes, hundreds and thousands of people selling and buying. But that is not the value of control when an independent, strong, large investor wants to sell a stake. Likewise, there is a situation where if the stocks are illiquid, when there is no trading happening, they are not listed or traded on a stock exchange, they are illiquid essentially. So there is a discount to be considered when it is a minority. It's a illiquid because you can't just go and sell it in the market. There are no buyers for that. You might have to do a lot of prospecting to find a buyer for that. So the concept of liquidity and control has to be clearly understood. I'll give you one more example. Suzuki and Government of India had a joint venture, which is one of the largest car companies in the world. Today, the largest in terms of, it is the market value of that company is larger than the market value of Suzuki. Now, government wanted to sell, they had 50-50 joint venture and millions of shares. It's 100% 50-50 joint venture. And government wanted to cede control and they wanted to sell only one share. And they paid what, $500 million for buying one share. But the value of one share was $500 million. That is not the value of all shares, correct? Because that one share would change control and the price was for the control. It was not for, so they appointed 5 consultants like us and they all went into a room and agreed to a certain price. And that's how. So Suzuki paid for one share. That's the price of control. You want to add that?
No, I'm just agreeing.
So that's the price of control. Sometimes you could pay beyond control because you, as a majority shareholder, you have control over the destiny of the company. You have control over the destiny of the cash flows. Not all the cash flows belong to you, but at least you have control over them in the sense whether you want to do capex or you don't want to do capex, whether you want to do expansion or you want to pay out dividend. So there is a special value which the dominant shareholder can get. And all of these things have to be considered when a mandate is taken. So are we valuing for control? Or are we valuing for liquid minority stake? Or are we valuing for illiquid minority stake? And values would be different.
And then you run into legislation and then run into jurisdictional issues. So the classic here in Australia is if you are taking over a public company, a listed company, even if you're buying from a minority shareholder, you must pay the control value. So we get our independent experts reports for on-market transactions are very focused about what is a control value of a company. In Australia, there are lots of fights between shareholders of private companies where there's oppression of a minority interest. Whereas in New Zealand, there is not so much discussion about minorities in private companies because there is an obligation under the New Zealand Act to buy out minorities at the control value, and it's an obligation on the controlling shareholder. So there can be legislative reasons why we need to bring these things into account or not bring them into account.
Some of the countries have this concept of a non-compete fee paid to the dominant shareholder. Now, some of the other countries have done away with that concept because essentially that takes wealth out of the hands of minority shareholders, and by virtue of a non-compete fee being paid to the dominant shareholder, they could take away the value. So these are the small nuances one may have to consider, and it could vary from jurisdiction to jurisdiction. What applies to South Asia may not apply to Australia and US.
The other thing you need to be careful about is our role. We don't always need to be engaged on an independent basis. so in Australia we have valuation guidelines and they're called APES 225, are the valuation services. Under our requirements, we must specify whether our valuation is prepared independently or not. We must specify, just let me emphasise, if our valuation is not independent. So if we were working on a transaction and I'm going to get a success fee, then I am not independent. I can reach a conclusion on the value if I was to be valuing an umbrella manufacturer. If I was to assume it rains every day for the next 365 days, I can do that, providing I'm saying I am not reaching this conclusion as an independent conclusion. So, there are times, though, where you must be independent. And certainly in Australia, if you're engaged for court purposes or for an on-market, a listed company takeover matter, you must be engaged as an independent expert. And your duty is to reach an independent conclusion. In fact, for court purposes, your duty is to the court, to help the court. You're paid by one party, but your duty is to the court.
So regardless of who is paying you, in a court matter, you are acting as a sort of an officer of the court. So you are responsible to that. And it's very, very different from the valuations done by the investment bankers because their duty is to do the deal. So there is an inherent conflict of interest. So one has to be clear whether it is an independent valuation or is driven by other extraneous considerations.
A couple of things about valuation methodologies. It's interesting, we're part of a global affiliation of valuation experts, and the valuation methodologies are basically the same around the world. You either look at an asset approach, a market approach, or an income approach. An asset approach assumes we're going to add together the value of the underlying assets to get to the value of the whole. Very hard to value intellectual property and intangible assets that way. Okay? But generally you add up the value of the components. Then there's a concept of a market approach. What's the value of this asset in a market? The methodologies change in name slightly in jurisdiction, but there'd be a merger and acquisition method. Find me a transaction that is comparable, that I can rely on. A guideline public company method. Find me a listed company that is comparable, that I can infer value from. Of course, you may also look at trading in a company's own shares. The final group of methodologies is the income approach, where we develop either capitalisation of earnings or a discounted cash flow, where we develop a valuation based on the value of the future income stream we expect to receive.
Yes, please. So again, the question comes back, what is the science in it and what is the art in it? Now, there is some science in it and there is some art in it. And it depends on the subject asset and its life cycle. It's early stage company, there will be a lot of art into valuation. If it's late stage developed, traded, listed company, there will be more science to it. There will be more objectivity to it. There will be more data. So in terms of the objective parameters that we have in our financial statements, history of the business, other comparable businesses which are there, several rules which are available, valuation methods which are well established, court judgments and court rulings. So there is a significant objectivity to it. Whereas in terms of art, all subjectivity. Sales forecast, whether this company is going to grow 10x from here or it's going to stay the same. What is the quality of financial statements? There is a subjectivity involved. Who has audited them? Earlier, we used to say Big Four audit, it's a gold standard. Can we say that now? I'll leave it for you to decide. What is the kind of economic outlook? I mean, what is the future holding for this company? How is the competition looking? Which is the new disruptive technology which is coming? So there is a lot of art into it. There's a lot of subjectivity into it. And every company, and we're taking an example after this, which over the life cycle of that company, the valuation approaches change, the thinking changes, and so from predominantly art, it becomes a predominantly science thing. So take that.
Yep.
I
Yep.
think we're going to pause for questions there. If we have any questions from the audience, we'll just have a quick look if anything comes through. We're good to go?
Yeah.
Oh, we've got some, okay. Can you give examples of valuation differences if used for tax versus M&A versus accounting?
Oh, yeah. Okay. Fun. Okay, this is a big question because the purpose of a valuation may define the definition of value and may, in some circumstances, define the methods you should use. And the classic example for me is for tax purposes in Australia, we use a concept of market value. For accounting purposes, we use a definition of fair value. Now, generally, those two sort of agree, generally. Occasionally they don't. But for mergers and acquisitions, I'll come into a completely different concept of value. So if I'm trying to work for the transaction or trying to work for the vendor, I don't want to look at the value of this business as a standalone business. I want to try and understand the value of this business to the prospective buyer. Once I can understand the value to the prospective buyer, I can argue for a higher price. So we can get quite different examples of value conclusions or from the purpose of the valuation can result in quite different valuations. And hence, when we do valuation work, we disclaim a valuation for a single user for a single purpose. If you are going to use this valuation for another purpose, bad luck, I'm no longer liable.
I think this question will be better illustrated or will be well illustrated through some of the examples that you guys are going to go through shortly as well. Do we have time for one more?
Yep. Anyone,
Yep.
which one would you like to?
Well, let's go to the ethics one. I think that's interesting.
Okay.
How can you make assumptions that are unreasonable and even ones you know to be wrong just because you're an advocate?
So I completely agree. You're not expected to do that. When we say advocacy, it is not acting in the definition of the Advocates Act or in the... What we are saying that an independent valuer will not, he has to essentially do valuation based on market participant model, wherein consider assumptions which are considered reasonable by a market participant. However, when you are acting like an investment banker, you have a larger latitude with you. You can actually try to convince your buyer or seller about the merits of doing the deal or merits of doing the transaction, considering the extra synergy that you may have. Now, that synergy could be participant specific. It should be only available to Simon and me. It is not available to anyone else. So we are willing to pay a much higher price for that business. And if a valuer is able to convince us, then yeah, it's a different. So undoubtedly, ethics are very, very critical, and that makes the backdrop of the whole valuation exercise. As an independent valuation expert, you are expected to make reasonable assumptions. But one question comes to me is what is reasonable in these new technology companies? Now, how on earth am I expected to know how is Uber going to perform in next 3 years? How on earth am I expected to know a new vaccine coming in or a new technology coming in and disrupting the whole industry? And how on earth will I know which one of those 10 participants, which one of those 10 competitors will be successful and the 9 that will fail? So there is some degree of subjectivity here, but I'm with you on the question that assumptions to the extent possible have to be reasonable, have to be backed by research, have to be backed by some judgment. Would you add on that?
The only thing I would say is, yes, look, if you believe a set of assumptions are completely unreasonable, it's very hard to stand behind assumptions or behind the conclusion even if you are working as an advocate. But if your assumptions are all reasonable but slightly optimistic, then you can still get a reasonable conclusion, and you may be able to substantiate that and justify your position. So if you take it too far, you cannot substantiate your conclusion. I'm sorry, we're going to move on, otherwise we're going to run out of time. Valuation is always more interesting in a fact set, in a case study. So what we've tried to do today is put together a little case study to bring out some issues as we go through it. For those, a lot of new faces in this crowd, I run a little case study here in Australia when I'm teaching valuation, and it's a little beer company, and we talk about that company. Well, I decided to extend that case study. So in this particular situation, we have three individuals, Abir, Balan and Sharan, is that how you say it, mate? Have been senior executives with a major brewing alcohol distribution company in India. Great experience in the beer industry. They also have a professional interest in the new emerging high-growth boutique beer market. They're considering setting up a small boutique beer company to take advantage of this opportunity. After a little bit of work, they decided, and I've backdated this, 2012, they wanted to take advantage of the emerging Big Bash cricket industry, and so they set up a beer company called the Kangaroo Hops. Hopefully you get the play of words. Hops is needed in the production of beer, so it's Kangaroo Hops Beer Company, to take advantage of this the fight between India and Australia in the cricket. So they set up the company with a minimum of capital, because they put together what capital they had. And as is common with these little brewing companies, they actually outsourced the brewing and the bottling so that they could concentrate their capital on marketing and distribution. They had some lovely slogans like run out a kangaroo, down a kangaroo faster than it hops. They had some lovely slogans, and very, very quickly, with their involvement with Big Bash cricket, the beer company took off.
And essentially all the money that they got initially was through their friends and their families and some fools as well. So any startup you go to, there is a narrative behind it. There is a story, people coming together, having some chemistry with each other, wanting to do something big. They have some experience behind it. So all these three gentlemen had good experience. So they pooled their money. They went to their friends, and they went to some fools as well who were willing to give them money. Now, this is how most companies start. This was a very small operations. And if you look at it, initial 3 years were like they were just about breaking even for 2 years. In fact, making some loss. And the third year, they were just about making some profit out of things. Now, how do you value such a company? Their intention is to maybe expand. They've done 2 or 3 years of operations. They're looking for a private equity fund to come in or some investor to come in, and they wanted to set up their own brewery, which these are the financials. Now, how would you value such a company? Would you consider a market approach? There are no companies similar to that. There are very, very few companies. There are no transactions of similar company. There is no visibility of future earnings. So if someone wants to do a DCF, you could create anything out of that. People say that if you torture Excel sufficiently, it will admit to whatever number you want, correct? So if you torture it well, so you could create whatever you wanted to do with this company. So you had no forecast available for future, but there is a great idea that yes, we can set up a brewery, an on-site brewery, and go ahead like that. So how would you value such a company? You want to take that?
Yep. So 2015, after 3 very successful years, it's been decided to establish a location brewery. Beautiful, right next to the cricket ground. but they've got to build $5 million to build this facility. How much equity will someone pay? So, of course, we've got this problem with how we do evaluation. But the classic would be they would come to someone like Rajeev and say, well, you need to value the company and you need to help me raise capital. The issue becomes, so our valuation date is going to be 2000. You're right, mate. Valuation date is going to be 2015. We're going to do the valuation for capital raising. Do we really want to use fair market value, or do we want to try and understand who our investors are and how much they might be willing to pay? What are we going to value? Well, we're going to value the company, but technically we're actually only valuing a minority interest because we're going to sell a minority interest. It's interesting, PE firms very rarely seem to get involved in the concept of a minority interest. Why? Because they write a shareholders agreement which says you can't change the brand of coffee that is served unless you get their approval. So they get very significant aspects of control very quickly. So our role would be as an advisor and potentially limited scope valuation. So what's a limited scope valuation? It's the classic where we're not signing off on the forecasts. We might not need to do an economic analysis and it might not do an industry analysis.
No, that may or may not be permitted in all jurisdictions because some of the jurisdictions where you are performing valuations expect you to do the full thing. And even if you are disclaiming the responsibility of not having done the full detailed review and analysis, I wonder whether that would come to your rescue.
Okay, so how are we going to value it? Well, we're going to sell this company based on what it's going to do in the future. The past, the losses, they're not relevant. You've got to believe the vision. We're going to take over the world with our Kangaroo Hops beer company. And we've heard this story more than you'd believe. So how would a private equity investor look at the deal? Would they go into a discounted cash flow? And this is honestly a misconception we deal with regularly. The short answer is no, a PE firm is often not interested in the valuation of the company. That's not their key driver. A private equity or a venture capitalist is often more interested in asking the question, if I invest in this company, how much can I sell my interest for in 3 or 4 years? So they're actually more focused on, yes, how much have I got to put in, but how much can I get out in 3 or 4 years? So here's the classic example. If the founders need $5 million to invest in the business now, and both the founders and the PE company agree that the company might be worth $25 million in 3 years, the PE investor requires a 3 times return on their money. This would imply an $8 million post-investment value now. So 25 million, ignore my rounding for a minute please, 25 million divided by 3 gives me an $8 million value today post-money, which means that is actually a $3 million pre-money investment. Take out the $5 million investment. So this would indicate a 37.5% equity for the founders. 3 divided by 8, 3 million divided by 8. But it doesn't actually mean that the company is worth $3 million today. What it means is if all our plans come true, we think the company could be worth 25 million, but we know we need 5 million to get there. It is not actually a valuation. It has very little to do with true valuation concepts of determining the value today of this company.
So this is at this stage where it is more art, where the investor actually takes a bet on the promoters, on the founders, that can they do it? Can they do the 3x or 4x multiple in the next 3 years? And there, the valuations are based, they are discussed more often on a cup of coffee rather than on Excel spreadsheets. That if I like you, and if I have trust in you, and if I have faith that you will deliver this, I'll give you whatever money you want. Many of the situations, they say, how much money you need? I'll say, I'll give you 5 million. I need 5 million, I'll give you 5 million. And at that stage also, they don't agree on a valuation. They said, okay, we'll agree on the dilution based on certain fundamentals being reached. So if you are able to reach X million dollars of sale or $5 million of EBITDA over a period of time, then yes, the dilution would be dependent on that. So it's a convertible instrument that is being invested in, and that could result in multitude of the stake of founders getting diluted significantly if they do not deliver. And if they deliver on that promise, then naturally they would have a larger share of the stake which is remaining. So these deals are structured in a very different way. The classic valuation model does not hold here. This is more, if I like you, I'm willing to bet on you, I will give you money provided you deliver.
In this regard, there's one thing that you need to understand. First of all, two things, I suppose. Valuation and PE pricing are different issues. But the second thing is private equity firms are focused on the exit. Why? Because time kills returns. As an example, if we assume our little beer company is successful in getting to a valuation of 25 million, let's make that assumption. But let's assume they do it at year 3 and the PE company manages to exit at year 3. Then the PE firm will get a 33% return. Fantastic. Let's just delay that exit by 1 year. So you still get a valuation of 25 million, but it's now 4 years. The return suddenly drops to 26%. If I push out to a 5th year, a few things go wrong in the time frame, there's a financial crisis, whatever, but we still get to our valuation of 25 million, but we're now out at year 5, the return the private equity company now gets is about 21%. So time kills. The moment you get involved with a PE firm, the first question they will ask is, how do I get out of here? When am I getting my money back? And if you can't answer that question, you will lose the interest of private equity investors very quickly.
Do you have any questions from the audience? All right. Can one safely conclude that hybrid, i.e. science and art, methodologies should be adopted in model valuations?
I'll take that.
You want to give it to me?
Yeah, why not?
Hybrid, yes, all valuation is science and art. No, not all valuation. There have been times when I've read a shareholders agreement and it said, you shall take last year's profit and you shall multiply it by 3, 4 or 5. So at that point there is no art. There is pure science. I am following a set of instructions. But most of the time when we're doing what I'd call true valuation work, it is a combination of both. There is a process, there is methodologies. There is maths, but at the same time, there is pure judgment. Is the company going to grow next year or not going to grow next year?
Just adding to that, again then, generally 70% of the cases are when there is a hybrid, and then there are extremes. When there is pure private equity kind, early stage venture capital kind companies, where there is more of art, maybe 80% art, and there's hardly any science there. And when there is pure science, and I've seen that also coming in when you are doing options valuations, you are doing complex financial instrument valuation, when you are doing complex real estate valuations have become automated nowadays. So this is more of an automated, there is more science to it, And when there are complex financial instruments, there is more science to it. So depending on what kind of asset class we are doing and what life cycle we are doing. So this open question here, please.
Now, this next question is quite interesting. I've seen both of those. So you touched on values coming out of Silicon Valley. When is the multiple of revenue now appropriate versus the more traditional EBIT or EBITDA?
I would say, for me, always the multiple of EBITDA or EBIT is always the more important thing. Actually, what is the purpose of business? It's to earn profit. It is not to earn revenue. People say revenue is vanity, cash flow is the only reality. Correct. So cash flow is reality. Many of these large businesses would eventually fail. They may be having a great revenue today, or but is that revenue model sufficient to give you profits? Now, because you don't have profits right now, the only matrix that you are using is revenue, but that would eventually, at some stage, the investors would ask the difficult questions, when are you getting the profits? So it is always profits, it is always EBIT and EBITDA, it's only the time frame. You're looking at EBITDA 1 year from now or 10 years from now, but eventually value is driven by the margin, the surplus that you generate. It is not driven by the revenue that you pull in. The hope in revenue is that eventually that revenue would lead to EBITDA. But if it doesn't, then the company would crash. It would certainly crash.
So I want to pick up one comment there. If I look at some of these Silicon Valley valuations, they rely on one valuation concept that we haven't talked about. It's a very important one. It's called the greater fool theory. This is worth $100 a share today, because I believe there's a greater fool next week who'll pay for 110. It has nothing to do with valuation. It is driven by speculation. It is not true valuation. At the end of the day, the only thing that generates value, true value, is the cash generated by a business, the profitability. Yes, you can go through early stages, but I'm a skeptic of why some of these companies have got billion-dollar valuations and still have no real prospect of generating a positive cash flow. I'm sorry, I don't understand those. I'm sorry, we're going to move on because we're going to run out of time. I can tell that already. Okay, so we were successful. We raised some capital from the private equity firms. 2018, the company has continued to grow and has a significant distribution network through India. Also, Australian cricket spectators have fallen in love with the beer and are keen to see it released in the Australian market. So the Kangaroo Hops Beer Company approaches some Australian beer producers about the prospect of a merger, in part to pay out the PE firm. Because Rajeev did such a great job last time, they've come back to Rajeev and said, Rajeev, you have to go to Australia, you have to find a company who's going to buy Kangaroo Hops.
Yes, please. Carry on.
I'll get carried away. Yeah. So we've got a couple of years of financials. We've been growing fantastically. You can see our forecast revenue is still going up. We've been making good profits. We've hit that capacity point where our profit is beginning to increase dramatically. So the questions immediately come, what are our valuation methodologies? Are we going to use future maintainable earnings or discounted cash flow? If we are going to use capitalisation of future maintainable earnings, are we going to use EBIT or are we going to use EBITDA? Are we going to use last year's profit or next year's profit? A little bit of me says it doesn't matter, providing you get the comparability of the data right. Historic EBITDA, prospective EBIT, get your data correct, you should get the similar valuations. The problems become, of course, when you confuse historic and prospective. So, shouldn't matter. If we're going to use a discounted cash flow, how much growth should we allow in those future years? Is the working capital level on the balance sheet consistent with what we need in the future? All of these are areas of judgment that then begin to roll into our valuation analysis. So, we're going to do a valuation as at 30 June 2018. It's going to be trade sale. Would I use fair market value or would I use investment value? Well, I'd probably be a bit careful about that. I'd probably talk to the vendors about what fair market value is, but I'd also help them understand what investment value might be. And that's something they can help me understand the synergies that may achieve. But we probably work a little bit between the two. Rajeev has been appointed as an independent expert, or has he? Well, I think he'd probably want to be engaged as an advocate, wouldn't you, mate? And again, what is the type of the report? Limited scope engagement is quite common because you're trying to help a company understand numbers very quickly. That concept of, one of the concepts I just picked up then was the investment value, the value to a specific owner. So we are immediately going to start looking at synergies. Where are those synergies going to come? How are they going to be? Who's going to achieve them? Generally, we look in three buckets. We talk about revenue synergies, cost synergies, and financial synergies. So classic would be, we think we can quickly bring Kangaroo Hops beer to Australia. The Australian punters, the Australian people are going to love it. It's going to be picked up and we're going to get an extra $5 million in value. Rajeev has worked hard and he's found a little company in Australia called Bogus. Now, does everyone understand the concept of bogus? Rajeev and I had a discussion about this offline, and it's a term mean fictitious or, so it's a bogus beer company. It doesn't exist, but we've created the company. If Bogus distributes their beer in India, we think we can achieve an additional $2 million in synergies.
But an important thing to understand here is that this synergy varies from acquirer to acquirer. It varies from person to person. It varies from transaction to transaction. One particular buyer may have a very different set of synergies, whereas the other buyer may look at it very differently. So this is very subjective. And when we are doing an independent market valuation, we have to consider what is considered as a market participant's view, which is a general view of majority of the market participant. However, having said so, there could always be one person who is willing to pay a much higher price for this because of his own reasons. So the synergies to that person could be very different from synergies to a general market participant. Yes, please.
So, different parties, different synergies. How do we value those synergies? What are the judgments? How quickly can Bogus be distributed into India? These are areas of judgment which of course are going to result in variations in our valuation outcome. They are things we need to consider and communicate to our clients so that the clients can understand the areas of judgment. After doing lots of detailed work, Rajeev has determined that the standalone valuation of the Kangaroo Hops company is 20 million. So we didn't quite get to the 25 million that the private equity were hoping for, but we got up there. The potential synergies, if Kangaroo Hops is distributed in Australia, now these are common synergies. These are synergies that any industry participant can achieve. Then there's a second lot of synergies. So if Bogus beer is distributed in India, these are unique synergies to Bogus Bogues. They're worth 2 million. So potentially the value of the company, the value of Kangaroo Hops to Bogus beer is 27 million.
And here it is important to understand that it is we have to step into the shoes of the potential buyer to understand what is that he's going to gain from it. The quantification of these synergies is subjective. It's often based on future cash flows of what could be achieved and what could not be achieved. So there is a great deal of subjectivity to it. It is the beauty in the eyes of beholder. So it is often, we need to communicate to our client well in advance that this is effectively the future goodwill value that we are going to pay for this. So how much to pay is often a matter of negotiations. But as an independent external expert, as a valuer, you need to communicate this. Often the transaction which is done is depending on the price and the needs and individual motivations and the urgency of buyer and seller. The transaction could happen at a price different from this and should happen at a price different from this. I've never seen a transaction happening at a value which I say. It is often higher or lower than that because often people are pulled by different other motivations which are other than the rational considerations, please.
So I have a question for you. We're actually going to get a little bit of industry or audience participation right now.
Sure.
So we've decided, and I've put up here, that the standalone value of kangaroo hops is 20 million. If you were the board or the CFO of Bogus Bogues, would you recommend that Bogus Bogues pay more than 20 million? Who sits there at 20 million and say that's all I'm willing to pay? One, okay? One brave soul. Now, we talked about there being some common synergies that any company in the beer industry is going to achieve. So that, if I add those two together, I get 25 million. Who, if you were the CFO or director of Bogus Bogues, would you recommend the purchase at more than 25 million? Any hands going up? Geez, we've got a where everyone is either asleep or everyone's very, very conservative bunch of accountants here. Thirdly, would anyone recommend paying up to 27 million? No. Okay. It's an interesting concept that comes up here, which is important in understanding valuation. So we've clearly said the standalone value of kangaroo hops was 20 million. In a competitive process, you would get a number of potential buyers being willing to pay more than 20 million because of the synergies they can realise. How much would they pay? Well, conceptually, they'd counter and counter bid until they got to the magic number of 25 million. Why 25 million? Because that was the common synergies. At that point, if someone bids beyond that, leaving aside Bogus Bogues for a minute, if someone bids above 25 million, they can't make any value add out of it. It's only worth 25 million to them.
And 25 million also considers the common synergies that every market participant would the common synergies which would accrue to any market participant. Often the deal is struck, as I said earlier, depending on the negotiation strength of the parties. So it could be 24, it could be 23.5, because eventually the synergies are shared between buyers and sellers. If buyer is very, very strong, he would try to push down the value to 20 million. If the seller is desperate, he would sell at 20 million. But if the buyer is desperate to go ahead and enter this and he wants this company anyhow, then he may have to end up paying a higher price. So pricing of the deal is different from independent valuation. Pricing of the deal is driven by the individual motivations, but when you are doing a valuation or you are reviewing a valuation, our job is not to justify the price that has been paid. That is the realm of what we call fairness opinion. In US and India and many other countries, there's a concept of, I think, independent external opinion or a fairness opinion, wherein you are engaged to opine on a deal which has already been concluded, that whether it is fair to minority shareholders or not, whether at that price, whether the shareholders should vote for it or should not vote for it. So at that stage, you are actually, the deal is already done, but you are opining on whether that is a right deal to vote on or not. So these are very subtle differences between a pure independent external valuation and a fairness opinion. And I must add that also it changes from jurisdiction to jurisdiction. What happens in US is very different from what happens in Australia.
one final concept that confuses a lot of people, and I just need to, this slide highlights it. If you were determining the fair value for accounting of this Kangaroo Hops company, we've said the standalone value is 20 million. But that weird concept is not the fair value of this asset for accounting purposes. The fair value of the for accounting purposes incorporates the common synergies that could be achieved by a market participant. So for accounting purposes, fair value could become 25 million. It is not the standalone value of the legal entity. It is what is the value of this asset in the market to market participants, which may get us towards 25 million. Be careful, post-deal, there may be other requirements for evaluation. Rajeev just mentioned fairness opinions. In Australia, we don't often require fairness opinions, but certainly there is a case situation where if you're selling for shares, selling for scrip, if you get a greater than 20% shareholding in the listed company, then you may well need an independent expert's report. And that can't be done by someone who is involved in the transaction. You would go to an independent firm and they would opine on whether that was fair and reasonable to the company that was doing the acquiring. Okay? So there can be all sorts of unusual requirements for valuations that come up.
I think we're going to questions again. While we wait for the questions to load, oh, we already have one. Okay. So often the seller asks you to value the blue sky brought by the purchaser to increase sale price. Thoughts?
Well, yes, when we look at the sellers, they would always want everything in the world. I've never seen a seller, I've never seen a promoter, a founder who believes that his company is going to be less than Apple, or he believes that his company is going to be less than the new Uber. They are so bought in, they are so sold on their concept. Sometimes we have to be more rational than them, we have to educate them, we have to give them hard data. That, okay, this is the company which was transacted at this price. Again, it is quite often subjective as well, because that company in a different market, at a different life cycle, there are already so many wannabe competitors of that. So seller often asks us, I've never seen the sellers, their projections are always going like this, their profit is always going to be like this, and some future date they are going to make up billions of dollars. But the value is paid for the profits now. So I agree, I very much agree with that. Often it makes our role very difficult because you have to consider and we have to educate them. In our analysis, we have to consider very high discount rates to temper those projections down. Sometimes we have to create multiple scenarios to tell that, okay, this does not look reasonable. What looks reasonable is this, but having said so, this is your version.
So Rajeev, that's where the art comes into it.
Yeah.
Look, I'll also say, and this moves from valuation into deal making. If someone gives you a set of forecasts and they're upwards to the right and they believe them, and then certainly here in Australia we have a concept of earn-out. I will give you a chunk, some money now, and I will pay you more in year 2, year 3, based on the future performance of the business. We are often asked to value that blue sky, and in some ways a discounted cash flow values future potential. Rajeev's right, we need to temper that, often need to temper that, but in a transaction sense, you need to deal with that differently as an earn-out. What we haven't yet got right in a valuation concept, I don't think, is how valuing that earn-out in comparison to current values. So there's a nuance that needs to be brought into the valuation community, which says, well, that's just not how we would do the deal. We would do the deal with an earn-out.
Do we have time for another question?
No.
No. All right, we'll move on.
Sorry.
Maybe we can do the PPA and then we can just open it, quickly run through the purchase price allocation.
I think that's right. Look, I'm sorry, we weren't sure how long this was going to take. So Rajeev and I wrote this while he was travelling, and we thought it was all going to, no one was going to ask any questions. So, trade sale occurred, bogus bogues acquired, kangaroo hops. The first thing that comes up then is purchase price allocation. IFRS 3, or in Australia, AASB 3. In some ways, although there are some lovely valuation concepts in purchase price allocation, I think it's easier to describe it as cutting the cake. The deal makers decided the size of the cake. All we are doing as valuers is cutting the cake up into pieces. What bit are we going to value as plant and equipment? What value are we going to value as intangible assets or brand name? And what residual bit are we going to call goodwill? That's all we're doing. We're cutting up the cake. So the question is, how big a piece of cake does Rajeev want and how big a piece of cake do I want? So that's what the process is. There can be tax consequences too. And tax can drive different outcomes. So in the United States, you get a tax deduction on all the tangible and intangible assets acquired. In Australia, we get a tax deduction on very few of the intangible assets acquired. But we actually get to uplift the value of our plant and equipment for tax purposes. So you can imagine that a CFO in Australia wants to uplift the value of the plant and equipment. They want to uplift the value of software because you get a tax deduction. And this weird concept of customer relationships, which is not a tax deduction, they don't want to know about. So we do get it, we get differences in jurisdictions causing differences in the intangible assets that get valued or the emphasis that gets placed on them.
So depending on where you are valuing, the accounting community, the tax advisors would push recognition of different intangibles which favor a situation. But as accountants and valuers, we have to realize that we have to follow the procedure as laid out in IFRS 3. So while there is some degree of leverage that we have, the process has to be followed in proper way. And we cannot have a situation where software is valued where there is no software.
No.
So that has to be recognized. But would you suggest we quickly run through maybe 2 or 3 minutes on this and then we leave the last session for questions? Would that be right?
Yep.
Yeah.
So the question we often see, and there is a confusion, certainly in the early days, there was a confusion in the terminology in the standard. And the standard referred to a purchase price and then adding on liabilities assumed. We saw many accountants start trying to add on things like creditors. I mean, isn't that a liability taken over? It was only when we came in and sort of reintroduced the basic valuation concepts. The liability assumed terminology actually refers to an interest-bearing liability, a loan, something, because we're trying to move from the deal price back to the enterprise value. So we're trying to pick up any things that fall outside of enterprise value. So the consideration that we need to value things is effectively the consideration for the enterprise value. So purchase price allocation. It involves starting at the equity value. In this case was 24 million. We added on the liabilities assumed of 2 million, which would give us purchase consideration of 26 million. There may have been some synergies which we've clearly identified. These were the synergies of common ownership of 5 million. Surplus assets, in this case we had 0, but there may have been some surplus assets, some land or something that wasn't required for operations. We need to make all of those adjustments. We would then have determined the value of the business, or the value implied from the transaction, might be a better way to refer to it, was 21 million. We look at the balance sheet, we determine there's $3 million worth of working capital. We look at the tangible assets, $10 million. So the purchase price allocation process is really about the end here. It's about $8 million. And how do we cut that up? How do we value that between the tangible assets? I'm going to quickly skip a slide or two. Tangible assets, intangible assets, I beg your pardon, the common ones we get to value: brand names, software, customer relationships, customer contracts. There's a lovely list. I haven't actually valued a play, but it's on there as a potential one. I have valued coursework, all sorts of weird things. Beauty is in the eyes of the beholder. So if I bought the business, I might not value the brand name. I don't think Kangaroo Hops is a good brand name at all. Rajeev, on the other hand, might think Kangaroo Hops is the best brand name in the history of the world. So all of a sudden, our reasons for buying will flow into the valuation of the intangible assets.
And whether the potential buyer continues to use that brand name or he wants to shelve it and starts his own brand name. So many of these considerations have to be thought about it to ascertain the life of the intangibles. And so therefore, there is an element of art, there is an element of judgment here.
Similarly, valuation of software. We've decided the company had some software. Why are we valuing it? What is the reason? Can I replace the software quickly? Certainly when we're dealing with IT companies, we often have the software as the primary asset. We would use a different methodology to possibly a piece of software that was easy to replicate. So all of these will flow into completely different values. Beauty is in the eyes of the beholder. How valuable is this asset to that particular acquirer? The customer relationships. I've never found an accountant who loves customer relationships as an intangible asset. It's normally a big thing that gets amortised, so it impacts EBIT, forces EBIT lower. It's artificial. No one seems to like it. We get to value it all the time. Key assumptions may well be: what's the expected future revenue? What's sales growth? What's our customer retention rate? And then we get into the lovely academic thing called contributory asset charges, all which will impact the value of our software. Customer relationships, beg your pardon.
Yes, there's one more concept of tax amortization benefits.
Yeah.
So that also needs to be considered here. So while it's not possible to maybe run the model in the very short time that we have, Amanda, here, but yeah, all of those considerations would go into when we are cutting the cake.
So, and by the way, we've got a little counter here which says we've got 1 minute left. That's why we're hurrying. So we've gone through the purchase price allocation and we've decided we've got some value to the Kangaroo brand, Kangaroo Hops brand. There was some software, there's some customer relationships. There was goodwill of $4 million, plus we need to add on the Synergy goodwill of $5 million. Remember, there was Synergy we paid for? Now, the weird thing under the accounting standards is that Synergy goodwill can be allocated to any CGU, cash generating unit, expected to benefit from the acquisition. So although we paid $5 million for Kangaroo Hops in India, that $5 million may actually be shifted across to the Australian CGU.
All right, let's go to questions, guys.
Absolutely on time. So happy to hear questions and maybe answer.
Well, I had a quick question for you. Rajeev, you said that very rarely do you conclude a valuation that ultimately results in the same purchase price or sale price. So do you think then as a valuer that it's important to conclude on a valuation range rather than a valuation point?
Yes. So in case if you are doing a valuation which is required for making a deal or making a deal, so then it is better to conclude a valuation range. Often a decision-making valuation is a range. Whereas if you are considering a financial reporting valuation, you need an exact numbers because accountants would love number because they want an exact number which could go into the balance sheet. So decision-making valuation is more often a range than a point estimate, whereas a financial reporting valuation or a tax valuation is often a number because that all the calculations would flow through that number.
Okay, thank you.
I'm sorry we ran so late. Rajeev and I are going to hang around, so happy to answer some questions, but I know you all have sessions to go to. Thank you very much for coming.
Thank you. Thank you.